What's up, everybody? Welcome to Heresy Financial. My name is Joe Brown, and I wanted to make this video because I've been getting a lot of questions recently and comments about the problems with returning to a gold standard, or questions about, hey, what will happen after this kind of the fiat currency collapse that we're witnessing starting to take place right now? What is that going to do? How are we going to resolve the issues that we've seen historically with the gold standard? So wanted to address those with really an unpopular opinion, even among gold bugs and hard money enthusiasts, what some good solutions are that circumvent some of the problems with the traditional gold standard, that also circumvent some of the issues that we're seeing right now with fiat money. Let's dive in. All right, so as you're aware, we are on a fiat standard right now. Fiat means by declaration, so that means the money that we use is money by declaration, just by law. It doesn't have anything of intrinsic value. Let's do a quick trip down memory lane, going by some of the major events in monetary history so I can show you exactly how we got here and where it's kind of leading. A couple thousand years ago, people realized that the best form of money was something that was universally accepted as having value, something that was really difficult to destroy, and something that carried a fair amount of value in a small amount of space, so that it was easy to store wealth in it. That's how things like gold and silver became widely accepted as money a couple thousand years ago. But as you might imagine, free market solutions to carrying around bags of coins that could be easily stolen came about pretty quickly as well. And so the goldsmiths who made the coins started offering services where they would store the gold or the silver for you, and they'd issue you a note, a receipt that would say, hey, anytime you come back, you give me the receipt, I'll give you your gold back. Well, pretty soon the goldsmiths realized that those receipts, those notes, were trading hands. And so if I needed to buy some shoes from you, instead of me going to the goldsmith, giving him my receipt, getting my gold, coming over to you, giving you my gold, getting my shoes from you, you then taking that gold and then going back to the goldsmith and getting a receipt, instead of going through that whole rigmarole, I would just give you the receipt and sign it over to you so that you could then have the claim on that same piece of gold that I used to have claim on. It was a much easier process. And so after a while the goldsmiths realized, hey, nobody's coming to us and returning the receipts in exchange for gold. And if they do, it's rarely ever, everybody at the same time. And so what they realized was, we've got all this gold, why don't we start to put it to work? And they didn't tell anybody they were doing this, but they started loaning out that gold and charging an interest rate on it. So now you have one gold piece that belongs to me that's being lent out to somebody else. That doubles the supply of money in that case, because I've got a receipt, a claim on that gold that's being traded as money, but now that's new money entering into the system that's being traded by that other guy. And so very quickly you have the amount of money start to explode in the system, because then if that guy then takes that gold and goes and deposits it with a goldsmith and gets a receipt, that new goldsmith can lend that same piece of gold out. So you very quickly had local economies where the amount of money in the system started to explode as the same piece of gold was deposited, lent out, deposited, lent out, deposited, lent out, and that pushed prices up, because when the amount of money in the system increases, that doesn't change the amounts of goods and services. So supply and demand, right? You've got more money chasing the same amount of goods and services. That means the only way to accommodate for that is prices go up to compensate for that, right? And so you had massive inflation locally happen, and pretty soon people would wise up, realize what was happening, realize that the goldsmiths had all been scheming them. They went to go get their gold back. It wasn't all there. There'd be a local collapse. Well, instead of outlawing this practice, countries decided to nationalize it. Instead of saying, no, you have to honor contracts and you're not allowed to take a deposit that's redeemable at any time and then loan it out for a loan that is of a long-term duration. Instead of outlawing that, they just said, no, we're going to backstop that and we're going to do it ourselves. And so central banking was developed. And in 1844, the bank charter in England said that the fractional reserve system, they didn't outlaw it. They said that was okay. And so that set precedents going forward. In America, we didn't have a central bank for most of our history. We tried it 3 times throughout our American history, and the last time after the Civil War, up until the creation of the Federal Reserve, we didn't have a central bank, and we had the greatest prosperity the world has ever seen, the greatest amount of growth at the same time as deflation, because when you have a supply of money that doesn't change, you have real growth, that the result of that is falling prices. So falling prices for everybody, everybody gets richer. You get more stuff for less cost. That was the way it grew. People's real wages actually went up even with prices falling across the board. And so that was the system that was in place. Well, we finally got a Federal Reserve. We finally got a central bank with the Federal Reserve in 1913. That put a backstop to banks because banks wanted to be able to operate under fractional reserve banking without going bust. They wanted to be able to issue more receipts, more notes for the actual amount of gold that they held without having to be exposed to a run on the bank. So Federal Reserve was going to be their backstop, be the bank of the banks. And so the Federal Reserve said, we're going to backstop you and be the bank of the banks. Well, the Federal Reserve was still held to a fractional reserve system. And so even though they were the bank of the banks, they still had to keep some gold in reserves. Again, this wasn't really this wasn't a 100% gold standard. It was a fractional reserve system set by the precedents of the 1844 Bank Charter Act in England. And so there were more claims on money in the system than there was actually money to be redeemed. That happened in 1913, and there was some big inflation that happened up until the end of 1919, 1920, which led to a collapse. Now, the government didn't do anything during the Great Depression. 1920, this was called the Great Depression at that time. They didn't do anything to rescue the economy. It fixed itself in about a year and a half. And then they resumed their growth, and there was more money expansion, more credit expansion, and more inflation that led to what we call the Great Depression now at this point. And this time they did do stuff to try and fix it, and instead of actually fixing it, the Great Depression, the impacts of that lasted for decades. So one of the things they did to try and fix this was outlawing gold and confiscated everybody's gold. And so FDR said, everybody, you need to turn in your gold. And what we're going to do then is, you can't, now people can't own gold anymore. You can't claim gold as a payment for debts because that was a clause that everybody said was they said, if I don't want dollars from you, I can ask for you to pay me back in gold. That was to prevent the lenders from being taken advantage of due to inflation, because if inflation happens, the person who borrowed money benefits because you're giving back dollars that are worth less. And so there was a gold clause in every debt contract that said, if I want, I can get gold back from you, because that prevents me from getting screwed by inflation. So FDR outlawed that. He said, nope, the dollar is actually money. You guys can't trade with gold anymore. You guys can't own gold anymore. And after he confiscated all the gold, then he upped the price of gold. And so that meant that now the Federal Reserve could print a lot more money because they only had to keep 40% reserves in gold compared to the amount of dollars that were in circulation. So they got more gold from the confiscation, then they raised the price of gold, so they were able to issue a lot more money into circulation. That gave the government a lot of spending power for all of its rescue plans, which didn't actually work. They just made things worse. So now you have an entire world enter World War II. Europe destroys itself, spends all of its gold because war is extremely expensive, and instead of rebuilding themselves, going back on a gold standard, what they did was they said, we'll just back up our currencies with the United States of America, because the USA got pretty rich in gold from the war because we stayed out of it till the end. And so America had a lot of gold, so they just said, hey, we'll back up our money with dollars because their money is backed up with gold, so it's basically the same thing. And so then America has this advantage. They're saying, hey, look, everybody in the world is using dollars as the reserve for their currency, and so we're just going to start printing dollars, and we're going to start buying stuff from all around the world, and we're going to take advantage of everybody using dollars here. And so they started buying stuff from around the world. America experienced a lot of false prosperity during that time until the rest of the world wisened up and realized America's printing a lot more dollars than the gold they actually have to back it up. And they've told us that if we redeem our dollars for gold, they'll do that. And so everybody said, I want to be the first one to get my gold back, because if I wait too long, there's not going to be enough gold because they've been printing a lot more than they actually have. And so the rest of the world started to go to redeem their dollars, and Nixon said, look, we're 2 weeks away from running out of gold, so I'm going to renege on the promise to redeem dollars for gold for the rest of the world, and basically confiscating the wealth of the world at that point. Now, the rest of the world was very used to just using dollars for transactions, and so the system stuck, even though that paper for anybody was no longer actually worth anything in terms of something redeemable for something with intrinsic value. So economic historians look at this and say, hey, all of the problems that we saw in the last 100 years have been as a result of the gold standard, as a result of governments going broke because they're, held to these limitations on what they can spend that are artificial limitations based on, a 40% reserve requirement or a 50% or a 25% or whatever the reserve requirement is. It holds them to these arbitrary limitations on spending that ultimately causes them to go broke. But under a fiat standard, especially the MMTers are the ones who are talking about this right now. Under a fiat standard, there are no limitations to what the governments the central banks can print. There's no, reserve requirement. But here's the thing. It wasn't a problem with the gold standard. It was the problem with the fractional reserve. If you issue more claims on something than can actually be redeemed, that's fraud. And it will always cause problems. And so that is the core issue of the problems that have originated from gold standards across the board. The only time there are issues in these big booms and busts and collapses is from an artificial expansion in the money supply and then a contraction, snapback, crash due to the fact that the money supply has been expanded beyond what the actual redemptions would allow. Now, because of this, there are very few of them, but there are a few, hard money enthusiasts out there that say the only way to really do a gold standard is to have 100% reserve requirement, that you can't have fractional reserve banking be in the system because that's what causes the problems. And they're right, but they don't go far enough. You see, we don't actually need the government to have any reserves to do a gold standard. And I'll say that again because even most gold bugs don't understand this, but you don't need a government to have any reserves to have a gold standard. The Constitution gives the federal government the power to mint coin and set the value thereof. Mint coins specifically because the founding fathers had all experienced paper money in their economies, in their colonies, and they knew it led to disaster. That's where the saying "not worth a continental" comes from, because they said, I think Thomas Jefferson said, you could a barrel of continentals is hardly worth a barrel of goods, something like that. I probably butchered the quote, but you get the point. They had all experienced massive inflation that happens as a result of paper money, and they said this cannot be allowed in our country. So in the Constitution, it was a change from the Articles of Confederation, actually. So in the Constitution, they wrote the federal government has the power to coin money, not print money, and set the value thereof. They didn't say coin money because paper money hadn't been invented yet. Paper money has been around for thousands of years and it's been tried over and over. They tried it themselves, doesn't work. They said coin money on purpose. And guess what? It had nothing to do with government having a monopoly on what money is or what money people can use. The money in circulation, it was Spanish coins at that point. There was no government monopoly on a currency, or in America, you could only use, silver and gold coins that were minted by the United States government's mint. That wasn't the case. Gold and silver was money. The power the federal government had was to create an official coin with a certain amount of gold or silver in it. And then they could name that thing the dollar. But everybody did transactions in money that came from all around the world, and you could travel anywhere in the world and transact in any gold or silver because gold and silver were actually money. You didn't need to do currency exchanges. It was just the amount of gold or silver that you were transacting with. And this is how money is supposed to operate. It isn't supposed to be controlled by a government. It's the actual government control of money, the monopoly on what money is, that causes the problems. You don't need the government telling you this is money and this is not. Now, they say that printing paper dollars doesn't cause inflation and it doesn't devalue money, but the reality is, and the way you know it is because they have a monopoly on it. If it didn't actually devalue money, they would make it legal for anybody to print their own money. But if anybody could print their own dollars, nobody would work for dollars because you can just print them without doing any work. And so it would overnight the intrinsic value of paper dollars and paper money would be gone. Versus something like gold or silver that you actually have to do labor in order to accumulate more. You can't press a button and print it. You actually have to mine it. You have to refine it. There's a labor cost associated with getting commodities. And so you never had that same problem when governments were not controlling what money was. The money still had value because the free market sets the value. And again, the issue with gold and silver standards or no standards, where the government doesn't determine what money is and people, free markets, determine what money is, the problems that arise from that are fraud and fractional reserve. And if you have a legal system set up where fractional reserve banking is illegal, because that kind of system is illegal in any other service or industry, you can't say, I'm going to hold this for you to somebody, make a contract that says you can come get it at any time. And then if too many people try and fulfill their contract, you're just bankrupt because you lent too many of them out. That should be illegal. It's illegal everywhere else. It should be illegal with money and banking. And you say, okay, well, why would we trust private businesses over the government? You know what? That's why we have a government that has a monopoly on our money, because what's to stop a private business from doing the same thing that the government does? Oh, I don't know, maybe the fact that if they do that, they'll actually go bankrupt. If a government does that, the only consequence is that they just get to do it more. I mean, I think the free market has just a little bit better of a track record of not committing fraud and not wasting money than governments do that have a complete monopoly on being able to do whatever they want by the use of force without any ramifications, especially regarding money. For thousands of years, every time you have a government monopoly of money, they do the same thing. They destroy the value of it by clipping the coins, by diluting the metal, by forcing people to use paper receipts or paper notes instead of the actual money itself, by stealing the purchasing power of it through hidden inflation. It's like governments have a 100% track record of doing all of the wrong things to money, yet we say they're the more trustworthy ones than the free market. So I'll end here. We do not need government to control or monopolize what is money. The free market can decide on its own. And in fact, it will be, because every time you have governments doing the same thing they're doing right now, where they massively start to abuse the power of issuing money, you have a currency collapse and a reset. And every time for thousands of years that this has happened, and it's happened plenty of times, the people will naturally resort to using gold and silver again. With technology today, who knows, it might be Bitcoin this time around. History says it'll probably be gold and silver, but it happens. And it's important to realize that we don't need a government monopoly on money. Even a 100% gold-backed gold standard, a 100% reserves system, is not going far enough. Let's get government out of our money, because very soon here, we will probably have the opportunity to have some say in what happens to money and what is money. Currency resets happen all the time throughout history. A gold exchange standard isn't far enough. An actual gold standard with fractional reserves isn't nearly far enough. A gold standard with 100% reserves isn't far enough. Get government out of our money, let the free market choose what money is, and may the best money win. Thank you for watching. If anything that I said was confusing, didn't make sense, you disagree, let me know in the comments section below, because I have a feeling that I'll be making a follow-up video about this topic, just because it's really something that even most hard money enthusiasts don't really talk about. Most of the time they're looking for, at the most, a 100% reserves gold standard. And so let me know what you think, and if there are enough common questions and thoughts, I'll probably make a follow-up video about this topic as well. So thank you for watching. Really appreciate you guys. Have a great day.